I am starting today the Book of Principle of Accounting. The first chapter of Principles of Accounting is usually Introduction to Accounting. So let's start today and study from the very basic about accounting. Stay with me on the Learning Vault channel and do not forget to follow my account. What is accounting? Definition. Accounting is the process of identifying, recording, classifying, summarizing, and communicating financial information to users for decision-making. In simple words, we can say that accounting is the process of identifying financial transactions, recording them, classifying them, summarizing them, and communicating financial information to users for decision-making. Objectives of accounting. What are the basic objectives of accounting? The basic objectives of accounting are: keep a record of business transactions, calculate profit or loss, show the financial position of the business, help management make decisions, meet legal and tax requirements. Users of accounting information. Who are the users of accounting information? There are two types of users who use the accounting information: the internal users and the external users. Who are the internal users? The internal users who use the accounting information are owners, managers, employees. Who are the external users who use accounting information? The external users are investors, banks, suppliers, government, and customers. Basic accounting terms. What are the basic accounting terms? The basic accounting terms are assets, liabilities, capital, we also call the owner's equity, revenue, expenses. Let's study these terms in details. What are assets? Definition. Assets are resources owned or controlled by a business that provides future economic benefits. For examples: cash, bank balance, inventory, furniture, and building. What is a liability? Definition. Liabilities are amounts that the business owes to others. They represent the business's obligations. We can simply say that a liability is the claim of the outsider against the business. For examples: bank loan, accounts payable, creditors, salaries payable, rent payable, and taxes payable. Capital. The owner's equity. Definition. Capital, also called owner's equity, is the amount invested by the owner in the business. It represents the owner's claim on the business. Assets after deducting liabilities. Formula. Owner's equity is equal to assets minus liabilities. Examples of the capital are cash invested by the owner in the business, additional capital introduced by the owner in the business. What is a revenue? Definition. Revenue is the income earned from the operations of a business through the sale of goods or services. For examples: sales revenue, which is generated through the sale of goods; service revenue, which is generated by providing services; commission income; and rental income. What are expenses? Definition. Expenses are the costs incurred by a business to earn revenue and operate the business. For examples: rent expense, salary expense, electricity expense, fuel expenses, advertising expense, and office supplies expense.